Check out what the satisfied Dan Gemus real estate team clients are saying about working with the Dan Gemus team. Visit dangemus.com.
I got to thank you for being a voice of reason in a sea of insanity.
Now back to the Dan Gemus Real Estate Show on AM800.
Okay, everyone, it's time for our segment with our good friend Ron Bondy from the Super Mortgage team, where we talk everything mortgages and financing. And, well, Ron, a big announcement from the Bank of Canada this week, which was its slated, announcement on whether or not they would increase or decrease the interest rate. And they decided to hold steady. Anything surprising there?
No, nothing surprising this month. To hold steady. They were predicting hopefully a cut in July a month or two ago, but data comes out every week,
sure,
or every couple of weeks, and changes the forecast. So with the data that just came out in July, they decided to hold steady, but they are still predicting a couple more cuts to come this year.
Now, you talk about the data, Ron. Do you don't have it in front of you, but what has the data been showing in the last little bit, essentially?
The data has been showing a stronger economy, which is why the Bank of Canada decided to hold rates. When they loosely is when the economy is doing well. They don't want to cut rates too quickly because that will drive it further up, right? Yep, exactly.
Okay. Well, so we'll see what happens. But again, they are still predicting one or two cuts further this year. So that's still, as of right now, what they're kind of expecting to happen over the next few months, right?
Exactly. Yeah. Historically, the Bank of Canada rate is higher than it usually is, so they are still expecting it to come down.
So before we get to our topic today, which is the 5 C's of credit, which will be interesting, tell us what is the typical buyer doing right now? Are you still recommending are you recommending a fixed rate, or are you recommending a variable? What are you recommending for those coming in right now?
So we are recommending a variable rate now, even though the Bank of Canada held steady today. We still are expecting, the economists are still saying that there is going to be a couple cuts. So why not take advantage of those cuts?
Yeah.
And instead of locking in at a higher rate right now, you can lock in. A variable can always be turned into a fix. So you can lock in, at the end of the year or the beginning of next year at a lower rate at that time if you're okay with a little bit of risk. So the variable does come with risk.
You mentioned that, Ron. So if someone goes with the variable right now, can they, whenever they want, lock in, or is there certain thresholds you have to hit from a timeline perspective?
No, typically all it is a $300 administration fee.
Okay.
And you can lock in with greater or equal time to what you have left. So for example, if you're in a variable for 6 months, then you can only lock into a 5-year fixed, whatever that rate is at that time.
Okay.
If you're in it for 1 year, you can lock into a 4 or 5. If you're in it for 2 years, 3, 4, or 5, so forth, so on.
Got it. Okay. All right. Okay, so let's jump over to our topic today, the 5 C's of credit. Let's talk about the 5 C's of credit. Ron, what have we got?
Yeah, so the 5 C's of credit are a standard framework used by the lenders to assess your credit worthiness.
Sure.
Okay. So what are they? So character, your character. So they actually look at what your character are. And we always joke in the industry saying good guy will pay, right?
Yep.
Lend to him, good guy will pay. But they actually do look at that. They look at, the applicant's trustworthiness, their track record on repaying debt. Like they look at their character. And then the second C is capacity. Okay, this assesses the applicant's ability to repay the loan.
That's important.
So that's definitely, important. Do you have lots of debt? Are you paying, this huge car payment that's going to be bigger than your mortgage? That might, hinder you being able to pay the mortgage, right? So capacity, like what can you handle? Capital is the third one. So this refers to financial resources and assets that's available to the borrower. Okay. For example, like your savings, your your investments, any money that you have that if you come on hard times, can you access? So that's the third C. Yep.
Okay.
The fourth C is collateral. So collateral being like, do you own your car? Do you own another house? Do you have a boat? You know, like what are the what is the collateral that you have? What are the assets that you have that for whatever reason, if the bank needs to go after you, they can grab those assets, right?
Would the bank consider investments as collateral, Ron? RSPs or any other kind of investments?
So that's the third C. That's capital.
Okay. All right.
So they do look at those, and you know, like if you have a lot of savings, then that means that you're a good saver. You're
Right.
most likely gonna pay your bills if you can save money.
Sure.
Now, a lot of people, you know, when we ask, hey, what's your assets or what's your capital? Like, what do you have in investments? What do you have in RSP? Some people just don't want to give that information up. And so is it necessary? No, as long as the other 5 C's are good,
Sure.
but it helps. So, you know, like we're not after your investments. We're not after anything. What we're trying to do is show the lender that you're a good saver and that you're a good risk, because they're giving you a lot of money in the end, right? Hundreds of thousands of dollars. So, you know, and if you don't want to show them, oh, I saved 100,000, then, you know, that kind of speaks to your character, right?
Sure it does.
So they're all intertwined here. And then the 5 C is conditions. This encompasses external factors that could impact the borrower's ability to repay a loan. So, for example, right now, if you're in the auto industry with everything that Kurt Trump is doing, you know, the lenders are going to look at you a little bit more heavily, because if Trump opens his mouth tomorrow and something changes in the auto industry, it's going to be drastic, especially in the area that we live, right?
So on that topic, Ron, are you seeing lenders right now getting a little bit tighter, or are you like, there's so much happening, you know, every single day. But today, you know, today's August 2nd, and like we said, right, there was news yesterday, there's news every other day. So things are changing so drastically. Are you seeing lenders getting a little shy right now? Are they getting a little more strict on who they're lending to, or has everything stayed status quo?
So year after year, the lenders always get stricter, and we hear it all the time. You know, oh, you're asking for more paperwork. We didn't have to do this 2 years ago. We didn't have to provide this 3 years ago, right? Every year it gets a little stricter.
Sure.
Definitely right now, lenders are nervous. They don't know what's going to happen.
Yeah.
Nobody knows what's going to happen. I don't even think that Trump knows what he's going to do, because he changes his mind all the time. But yeah, 100% they're nervous. But as long as you fit the envelope, you can prove the 5 C's of credit, they're still lending. So it's not like they're shying away, but they are being more cautious.
We have a texter that asked a question. Basically, if I'm paraphrasing a little bit, it's a long text, but they're asking about employment and what a lender looks for with regards to employment. And I think what they're alluding to is, can they be working part-time, or must it be a full-time position?
So it's all about the length of time that you have that job.
Okay.
So if you're working part-time, lenders like to see 2 years working part-time. They take those 2-year average, and that's how they determine what your income is, because you're working part-time, right? You might work 10 hours one week, 20 hours the next week, 30 hours the week after that, back down to 5. Like it's all around the map, all over the map. So they want to see stability. Now, the way around that rule is if you're part-time and you get a minimum guaranteed amount of hours, and you get a letter stating that, and your pay stubs trend that way, then we can use that as your wage. So,
okay.
So your employer is guaranteeing you that you are going to have this many minimum hours. And as long as your pay stub matches that, then we can also use that, and you don't need to follow that 2-year rule.
Another question's come in, Ron. Someone is asking if it ever happens where a lender does not renew a homeowner. Does that ever happen?
So yes, that definitely does happen. But the only reason that would happen, there's a couple reasons, but they're pretty drastic. So like, if you missed a mortgage payment, lenders won't renew you.
Okay.
Another one that we've seen is, so some banks buy other banks. So for example, a recent merger last year was RBC and HSBC, right? RBC bought HSBC. Now we're seeing, if you ever declared bankruptcy with RBC, they stop working with you. They won't do anything with you if you wrote off some of the debt that you owed them.
Okay.
So what's happening right now with a few people is they were with HSBC, RBC bought them, so they bought all the mortgages. Now the mortgages from HSBC are up for renewal, and if these people had declared bankruptcy previously with RBC, now RBC is not renewing them because like they got the mortgage through HSBC, not RBC. So they decided to walk away from those clients that owed them money.
Now, Ron, would there ever be an issue? The economy right now, some auto workers are out of work or they're laid off. Would there ever be an issue with someone laid off not getting renewed because they're laid off, or how would that work?
Nope.
Okay.
Because as long as you haven't missed a payment,
Okay.
lenders will just renew. They don't requalify you. Unless you're looking to pull money out, that's when, or stretch your amortization out. That's when you have to requalify. But for renewing, they just renew you, unless, like I said, unless something drastic.
So the key is just don't miss a payment. Just keep on making.
Don't miss a payment.
Yeah.
Yep. Don't.
Okay.
There are certain bills that don't report to the credit bureau, and those are the bills that, those are the bills that you kind of, if you're short, you want to,
Okay.
miss. You don't ever want to miss your mortgage.
Okay, fair enough. Ron, if someone has questions out there, what's the best way to reach out to you here at the Super Mortgage team if they have any questions about renewing or getting approved for a mortgage?
So they can give me a call on my cell phone, 519-791-2961. They can email me at ronaldbondy.ca. Or sorry, that's my website. Or they can email me at ronbondy@supermortgageteam.ca. Or they can get in touch with one of your lovely agents.
Now, Ron, before I let you go, our fun question today, and I'm putting you on the spot because you're out of town today, so I appreciate you taking time to make the call. But our fun question today is, what's one item in your fridge that you could never live without? Mine's ketchup and mayo. What would you say is in your fridge that you couldn't live without?
I would agree. Mine would definitely be ketchup.
Yeah. I'm French.
Ketchup goes on everything.
You're absolutely right. It goes on everything. There you go, Ron. Thank you so much. We'll chat with you again in a couple of weeks, and I appreciate you taking time for us as you're out of town today. So thanks so much.
Sounds good. Thanks, Dan.
All right, that's Ron Bondy with the Super Mortgage team. Lots of great information there, and you can always learn more, right? So if you have any questions, reach out to us. We'll connect you with Ron Bondy over at the Super Mortgage team. Back with more and more of your fun answers as well with Aaron and Steve right here on the Dan Gemus Real Estate Show.